What if everything you've been told about the stock market is about to change? Now, what if the biggest opportunity or the biggest danger is just around the corner? While most investors are focused on today's headlines, smart money is preparing for something far bigger. In this video, we'll uncover the shocking signals, the hidden market risks, and what you should do before the unthinkable happens to stocks. Stay with me, because the next few minutes could completely change how you invest. Before we talk about what could trigger the next major move in the market, we need to look at something that most people are completely overlooking. Throughout history, some of the biggest market shifts have happened when investors felt the most comfortable. That's what makes this situation so interesting and potentially so dangerous. Right now, if you turn on financial news or scroll through social media, you'll find plenty of reasons to feel optimistic. Many stocks have delivered strong returns, new technologies are creating excitement, and investors are constantly searching for the next big opportunity. On the surface, everything seems normal. But when we look beneath the headlines, a different picture begins to emerge. One of the first warning signs is valuation. Simply put, many stocks are trading at prices that assume near-perfect conditions for future growth. Investors are willing to pay increasingly higher prices today because they expect companies to perform exceptionally well tomorrow. The problem is that expectations can become unrealistic. When expectations rise too far above reality, even a small disappointment can trigger a significant market reaction. Think about it this way. Imagine a company reports excellent earnings, but those earnings are slightly below what investors expected. In a balanced market, that might not matter very much. But in a market driven by high expectations, even good news can be treated as bad news. Suddenly, investors begin questioning whether the growth story is as strong as they once believed. Confidence starts to weaken, and selling pressure begins to build. Another signal worth paying attention to is investor sentiment. When markets rise for extended periods, people naturally become more confident. Confidence itself isn't a problem. In fact, confidence is an essential part of investing. The danger comes when confidence turns into complacency. Complacency is when investors stop asking tough questions. It's when people begin assuming that markets will always recover quickly, that every dip is automatically a buying opportunity, and that risk no longer matters. History has repeatedly shown that periods of extreme optimism often occur near important turning points. Not because optimism causes crashes, but because when everyone already believes prices will continue rising, there are fewer buyers left to push them even higher. We've seen this pattern before. Different decades, different industries, different technologies, but the same human psychology. Investors become convinced that this time is different. They believe old rules no longer apply. They focus on success stories while ignoring potential risks. And then, when reality fails to meet expectations, markets adjust rapidly. What's especially important to understand is that market corrections rarely announce themselves in advance. They don't arrive with a warning label. There isn't a bell that rings before prices begin falling. Most major market moves start quietly. A few investors become cautious, certain sectors begin showing weakness, economic data becomes mixed, confidence slowly fades. Then suddenly, what looked like a small concern turns into a much larger problem. This is why smart investors focus on signals rather than emotions. Emotions tell us to follow the crowd, signals tell us to pay attention to facts. And some of those facts deserve our attention right now. We're seeing elevated valuations in several areas of the market. We're seeing heavy concentration of investment into a relatively small number of popular companies. We're seeing investors chasing momentum and assuming that recent trends will continue indefinitely. None of these signs guarantee a market decline. But together, they create an environment where surprises can have a much larger impact than many people expect. At the same time, uncertainty remains present beneath the surface. Economic growth, inflation, interest rates, corporate earnings, and global events all continue to influence investor behavior. Markets may appear calm today, but calm conditions can change very quickly when expectations shift. The goal isn't to become fearful. Fear is just as dangerous as overconfidence. The goal is awareness. Successful investors understand that markets move in cycles. Periods of excitement are often followed by periods of caution. Periods of rapid growth are often followed by periods of adjustment. Recognizing these cycles doesn't make you pessimistic. It makes you prepared. And preparation is what separates investors who react from investors who succeed. Because when the crowd finally notices the warning signs, the biggest moves may have already begun. Now, once we've recognized the warning signs, the next question becomes obvious. What could actually trigger the next major move in the stock market? This is where many investors make a critical mistake. They spend all their time looking for one single event, a headline, a crisis, or a dramatic announcement that suddenly changes everything. But in reality, major market shifts rarely happen because of just one factor. More often, they occur when several forces begin pushing in the same direction at the same time. Think of the market as a massive ship crossing the ocean. It doesn't suddenly change course because of a single wave. Instead, multiple currents gradually influence its direction until the movement becomes impossible to ignore. The stock market works much the same way. One of the most important forces investors watch is interest rates. For years, markets have become extremely sensitive to decisions made by central banks. When interest rates are low, borrowing becomes cheaper, businesses can expand more easily, and investors are often willing to take greater risks. This environment tends to support higher stock prices. However, when interest rates rise, the situation changes. Borrowing costs increase, consumers may spend less, businesses face higher expenses. Suddenly, future profits become less certain. Investors start re-evaluating how much they're willing to pay for stocks, especially companies whose growth depends heavily on future expectations. What's interesting is that markets often react not only to actual rate changes, but also to expectations about future rate changes. Sometimes a single statement from policymakers can move billions of dollars because investors are constantly trying to predict what comes next. In many cases, uncertainty itself becomes more influential than the decision being made. Closely connected to interest rates is inflation. Inflation affects nearly every aspect of the economy. When prices rise too quickly, consumers have less purchasing power. Businesses face increasing costs for labor, materials, and operations. Profit margins can come under pressure, and investors begin questioning whether companies can maintain the growth they've promised. At the same time, inflation creates a difficult balancing act for policymakers. If they act too aggressively, economic growth could slow. If they act too cautiously, inflation could remain stubbornly high. Markets constantly evaluate this balance, and even small changes in expectations can create significant volatility. But economic factors alone don't tell the whole story. Corporate earnings play a huge role in determining market direction. At the end of the day, stock prices are ultimately connected to business performance. Investors may become excited about trends, technologies, and future possibilities, but earnings remain one of the strongest indicators of a company's health. This is where expectations become incredibly important. Markets often price stocks based on future growth rather than current results. When companies consistently exceed expectations, confidence grows. But when earnings begin missing forecasts even slightly, that confidence can weaken very quickly. We've seen this happen many times throughout market history. Companies report results that would normally be considered strong, yet their stock prices decline because investors expected something even better. In highly valued markets, expectations become so elevated that reality struggles to keep up. Then there are global events, the factors nobody can fully predict: geopolitical tensions, trade disputes, supply chain disruptions, energy shocks, and unexpected economic developments can all influence investor sentiment. The challenge isn't simply understanding these events. The challenge is understanding how markets will react to them. Sometimes a major event creates only a temporary market response. Other times, relatively small developments trigger much larger reactions than anyone anticipated. The difference often comes down to investor psychology. And that brings us to perhaps the most powerful force of all: human behavior. Markets are driven by numbers, but they're also driven by emotions. Fear and greed have influenced investors for centuries, and they continue to do so today. When confidence is high, investors become willing to overlook risks. When fear takes over, they often ignore opportunities. What's remarkable is how quickly sentiment can change. Optimism can dominate the market for months or even years. Then one disappointing report, one unexpected economic development, or one shift in expectations can cause investors to suddenly view the same information through a completely different lens. This emotional cycle is often amplified by technology. News spreads instantly. Social media accelerates reactions. Information reaches millions of investors within seconds. As a result, market moves can become larger and faster than they were in previous decades. And then there's the growing influence of artificial intelligence and algorithmic trading. More decisions are now being influenced by systems that react automatically to economic data, market trends, and price movements. These systems can increase efficiency, but they can also amplify volatility during periods of uncertainty. When all of these factors begin interacting, interest rates, inflation, earnings, global events, investor psychology, and technology, the market can reach a tipping point, and that's often when the biggest moves occur. The investors who understand these forces aren't trying to predict the future with perfect accuracy. They're simply preparing for the possibility that the future may look very different from what the crowd expects today. So, after looking at the warning signs and understanding the forces that could trigger the next major move in the market, we're left with the most important question of all: what should investors actually do about it? This is where many people go wrong. The moment uncertainty enters the conversation, emotions begin taking control. Some investors become overly fearful and sell everything at the first sign of trouble. Others become overly confident and ignore every warning sign because they believe markets can only move in one direction. Both reactions are driven by emotion, and both can be incredibly costly. The reality is that successful investing has never been about predicting every market movement perfectly. No investor, analyst, or institution can consistently forecast exactly what will happen next. The goal is not perfection. The goal is preparation. Think about professional athletes. They don't know exactly what will happen during a game. They don't know every challenge they'll face or every decision they'll need to make. What they do know is that preparation gives them the best chance of success regardless of what happens. Investing works the same way. One of the most powerful tools investors have is diversification. It may not sound exciting, it doesn't create flashy headlines, it rarely becomes a trending topic on social media. But diversification remains one of the most effective ways to manage risk. When investors become too concentrated in a single stock, sector, or trend, they expose themselves to unnecessary vulnerability. If that investment performs well, the rewards can be significant. But if conditions change unexpectedly, losses can accumulate just as quickly. Diversification acknowledges a simple truth. Nobody knows the future with complete certainty. By spreading investments across different assets, industries, and opportunities, investors reduce their dependence on any single outcome. They create flexibility, and flexibility becomes extremely valuable during uncertain times. Another critical principle is maintaining a long-term perspective. One of the greatest challenges in investing is separating short-term noise from long-term reality. Every day, markets generate new headlines, every week brings fresh predictions, every month introduces a new reason to feel either excited or concerned. If investors react emotionally to every headline, they often find themselves constantly buying high and selling low. They chase optimism when prices are rising and panic when prices are falling. Over time, this cycle can seriously damage long-term returns. Successful investors understand that volatility is not the same thing as failure. Markets have experienced corrections, recessions, crises, and periods of uncertainty throughout history. Yet, despite those challenges, long-term growth has remained one of the defining characteristics of the stock market. That doesn't mean every investment succeeds. It doesn't mean risks disappear. It means that patience often becomes a competitive advantage in a world obsessed with immediate results. At the same time, patience should never be confused with passivity. Investors still need to evaluate their portfolios, understand their risk exposure, and ensure that their strategies align with their goals. Preparation is not about doing nothing. It's about making thoughtful decisions before emotions have a chance to take control. Another important concept is liquidity, the value of having cash available when opportunities appear. During strong bull markets, investors often feel pressure to keep every dollar invested at all times. Holding cash can seem unproductive when stocks are rising rapidly, but market history repeatedly demonstrates that some of the best opportunities emerge during periods of uncertainty. When prices fall and fear spreads throughout the market, prepared investors gain flexibility. They can evaluate opportunities objectively while others are reacting emotionally. They can take advantage of attractive valuations instead of being forced into difficult decisions. This doesn't mean trying to time the market perfectly. Very few people can do that consistently. Instead, it means maintaining enough flexibility to respond intelligently when conditions change. Perhaps most importantly, investors must learn to control their emotions. Fear and greed have influenced financial markets for generations because they are deeply human emotions. When prices rise, greed whispers that success will continue forever. When prices fall, fear convinces people that recovery is impossible. The challenge is that both emotions distort decision-making. They encourage investors to focus on short-term feelings rather than long-term fundamentals. They replace strategy with impulse. That's why discipline matters so much. Discipline allows investors to follow a plan when emotions are telling them to abandon it. Discipline encourages patience when others are becoming impatient. Discipline creates consistency in an environment that often feels unpredictable. And this brings us back to the central message of everything we've discussed today. The unthinkable isn't necessarily a market crash. It isn't necessarily a recession. It isn't necessarily a single event that changes everything overnight. The truly unthinkable possibility is that many investors may be completely unprepared for whatever comes next. Markets will continue evolving. New opportunities will emerge, new risks will appear, economic conditions will change, investor sentiment will rise and fall. That cycle has existed for generations, and it will continue long into the future. The investors who succeed won't be the ones who predict every headline. They'll be the ones who remain informed, disciplined, adaptable, and prepared when uncertainty arrives. Because when everyone else is reacting, the prepared investor is already ready. So as we conclude, let's return to the question we started with. What if the unthinkable is about to happen to stocks? Throughout this discussion, we've explored the warning signs that many investors are overlooking. We've examined the powerful economic forces that could trigger the next major market move. And most importantly, we've talked about what separates successful investors from those who get caught off guard when uncertainty arrives. The truth is, nobody knows exactly what the market will do tomorrow, next month, or even next year. Anyone who claims otherwise is selling certainty in a world that has never offered it. Markets are complex, unpredictable, and constantly evolving. But while we cannot control what happens in the market, we can control how prepared we are for it. History teaches us that every major market shift creates both winners and losers. Not because some people can predict the future perfectly, but because some people prepare while others assume the good times will last forever. The biggest opportunities often emerge when fear is highest. The biggest risks often appear when confidence is at its peak. That's why smart investing isn't about chasing headlines, following the crowd, or reacting emotionally to every market move. It's about understanding risk, staying disciplined, thinking long-term, and remaining flexible enough to adapt when conditions change. If the unthinkable does happen, panic won't protect your portfolio. Fear won't create opportunities. And wishful thinking won't preserve wealth. Preparation will. Because when markets become volatile, when uncertainty dominates the headlines, and when investors everywhere are searching for answers, the people who have a plan will always have an advantage over those who don't. The future may be uncertain, but one thing is clear. The next chapter of the market will reward those who are informed, disciplined, and prepared. The unthinkable may be coming, but for prepared investors, it may become the opportunity of a lifetime.